Great. It's great to have everybody back. We're about to start our second joint panel. It's a joint panel with the Economic Research Service, and we're very glad to have Gloria Univer, the acting administrator of the ERS, to offer an opening remarks. Gloria.
So thank you. It's one of the joys of being an acting administrator for a brief term is to get to experience the many diverse ways in which ERS contributes, and it's a pleasure to be here for this jointly organized session with CFTC. This is really a fantastic collaboration, and looks like it will be a very interesting session. I came to the conference this morning from a briefing on our forthcoming food security statistics as one indicator of the breadth of issues that ERS addresses. And our data, information, analysis, and research covers everything from farm to food, rural to resources, and domestic to international. Let me take just a second and give you an idea of the span of what we do in our agency. We produce information of such long standing that many people take it for granted or are not sure where it comes from. For example, it's our food disappearance data that's responsible for the factoid that chicken has overtaken beef in the American diet. But we also provide information in some new and innovative formats that our users are only beginning to utilize and explore. For example, our food desert locator, which is the basis for some forthcoming investments by Walmart in underserved neighborhoods, or our rural atlas, which allows people to look at different dimensions of the rural economy. So in addition to food security statistics, we also provide an analysis of food marketing costs through the Food Marketing Bill, farm income estimates, which will be coming out next week, the latest ones, and measures of agricultural productivity. Now, of course, those data also inform our research program. And turning to the research of most interest to this audience, let me provide a brief overview. ERS Commodity Market Research and Outlook Program provides public and private decision makers with an understanding of market developments and trends. So, for example, ERS plays a lead role in USDA's USDA's monthly World Agricultural Supply and Demand Estimates, the WASDE report, and also in the annual 10-year baseline projections. ERS's market analysis programs monitor current market conditions and publish findings on major issues that affect food and agricultural markets. The Outlook newsletters inform production, marketing, and risk management decisions of agricultural producers and businesses. So, for example, analysis provides insight on the impact of increased production of biofuels on commodity markets, the impacts of weather and policies in major producing and consuming regions, and the growth of emerging economies in influencing market demand and prices. And in fact, our market analysts frequently inform policymakers and the media about impacts of recent market developments, especially during periods of price volatility and international disruptions. For example, ERS analysts were widely sought by the media and government officials for insights on the impacts of the earthquake in Japan this year, its impact on agricultural trade and prices. Some of the research conducted at ERS is designed to measure the influence of regulations and institutions, such as futures markets, that shape the performance of U.S. ag and food markets. This research examines the impact of regulations and market-based institutions designed to address market imperfections, reduce transaction costs, facilitate pricing and risk management, and protect producer and consumer welfare. Recently, local food and organic markets have been an area of increasing interest, with research projects examining the size, scope, regulation, and performance of local and organic food markets, and assessing the costs and benefits to consumers and producers of alternative food distribution systems. Increasing interest in competition issues has also led to new studies on price spreads and price transmission. One series of projects examines price transmission from the farm to retail level for dairy, beef, and pork. Other projects examine and measure the degree of fluctuation in agricultural prices and the transmission of price changes and price variability in both domestic and international markets. And interestingly, for someone is long in the tooth like myself, some of those studies have found the changing transmission between commodity and food markets means that commodity price volatility has a different meaning for food consumers now than it did in the 70s, for example. Of course, price discovery is central to market performance, and increased interest in the performance of agricultural commodity futures markets coincided with recent historic price increases for many cash commodities and raised questions about whether market fundamentals, market design, or increased activity of certain trader groups influence price movements. Now, fortuitously for ERS, this also coincided with the arrival of Sally Thompson, and with her strong expertise and research foundation in this area, she reinvigorated our ongoing research program. This program concentrates on price discovery, risk management, and other market performance issues in both cash and futures markets for agricultural commodities, and examines the critical factors affecting price levels, volatility, and price discovery. ERS has an ongoing intramural and extramural research program. That is, we often work closely and collaborate with university researchers and thus have both in-house and extramural research. All of this is going to be represented here by in this coming session, and as you've also heard from elements of this research program during the rest of the conference. And I don't want to take any more time because I'm interested in hearing the results of this research myself. So let me turn it over to Dr. Thompson to introduce the session.
I'm going to follow the exact format of the previous session. That works well, and these minimal introductions. I figure everybody's got a smartphone and can Google everyone. And so we'll start right away in the order of the presenters. And so that means first person to speak will be Aaron Smith from University of California, Davis. Thanks, Aaron.
Thanks to everybody. Thanks to the organizers for putting together this meeting. This work that I'm going to talk about today is co-authored with Phil Garcia and Scott Irwin at the University of Illinois. And we do have a paper available. It's not posted anywhere yet. It will be soon. But if you'd like a copy, please send me an email. So I'm going to start with a question. The question is, how much would you have been prepared to pay if you were interested in buying wheat from a Toledo elevator in July of 2008? Maybe not too many in this room have a guess, so I'm going to help you a little bit. On that day, a natural thing to do might be to go to the futures market. So you could go and look at quotes, and on that day, you would see that the futures price for delivery of wheat to Toledo, the cheapest delivery location, in July 2008 was $8.49. So that's a price for immediate delivery. And then from there, the term structure was upward sloping. So you would look at that July price and you'd say, what, $8.49. That's about the price that I'd be prepared to pay if I wanted to buy wheat in Toledo today, because I could equivalently get that wheat by entering into a futures contract and standing for delivery. That's the answer. Okay. So on that day, in fact, cash prices were at $7, which is substantially below the futures price. Okay, so what we do in this paper is try to explain this phenomenon, and it wasn't unique to just that particular expiration. We can potentially, markets sometimes on particular days do funny things, but this was a sustained period of a failure of futures prices to converge to cash prices. So this graph shows Chicago wheat as the blue curve, which is the poster child for this phenomenon. It's the market that's seen the largest extent of non-convergence. But you can see also other markets there, corn, Kansas City wheat, have had significant episodes where futures have failed to converge to cash. So the first question we might ask before we go into this and try and explain this phenomenon is whether we should care very much about this. The first point is that these markets, futures markets, exist primarily to perform price discovery and to facilitate risk management by market participants. And you might worry that if the futures price is in fact not discovering cash prices, that the market may not be fulfilling these important functions. Another thing, sort of looking more generally beyond agricultural markets and beyond commodity markets, a lot of what we do in economics and finance is predicated on the notion that arbitrage opportunities get taken away very quickly. If there are dollar bills on the sidewalk, people tend to pick them up. And you might look at this and say, it doesn't seem like that's happening here. Why aren't people buying wheat for $7 and delivering it on futures at $8.50? So we want to understand more generally whether and how this is a failure of arbitrage. And one thing that we'll show here is that in fact this phenomenon provides a unique setting in which to see whether present value type relations explain prices. So what we're going to show is that in fact the magnitude of the basis, the gap between expiring futures and cash, can be thought of as the present value of some future stream of payments. So we're going to be able to ask, can the market in fact do that present value calculation and come up with a sensible price? So some hypotheses you might raise, and I hinted at some of them perhaps on the previous slide. One prominent one is a limits to arbitrage kind of story. So and this story was what led to a report by a Senate subcommittee in 2009, where they said, and there's a quote there, that essentially commodity index trading was the problem. So commodity index traders have come into these markets on the long side, have pushed up futures prices, and arbitrageurs just cannot keep up. Okay? So, and there are a lot of theories we have in finance about limits to arbitrage. If in markets we have some subset of traders who are perhaps trading in some irrational way, arbitrageurs are constrained in some way, informationally or with capital constraints or whatever, then they may be unable to actually follow through and arbitrage price inefficiencies away. So that's a potential hypothesis, in fact, one that we're going to rule out. Another story you might hear is that there are lots of really big firms in this market, especially in the delivery market, and those are, big firms do bad things, and so there's something funny going on here. We don't know what it is, but it must be those big firms exercising market power in some way. And again, that's something that we're going to rule out with our results. And what in fact we'll show is that we can explain this phenomenon quite easily as an example of competitive firms responding optimally to the way that the market is set up. So this is an institutional structure issue rather than something else more nefarious. So I'm going to give it to you in a nutshell. Then I'm going to go ahead and at least give an outline of the model, the theoretical model that we put together to explain this phenomenon. And then I'll go to the empirics and show you what the data say about our story. So the key point here is that if you buy grains, you take a long position in futures and you take delivery, you don't get actual grain. Okay? So no one takes a truck, backs it up, and dumps wheat in your yard. What in fact you get is you get a delivery instrument. So this is a warehouse receipt, or now in most of these markets, a shipping certificate. And you want to think about this as a piece of paper. So I'm delivering to you a piece of paper. That piece of paper says that you can come get your grain from me when you want to. Okay? And that when you want to is an important point here. So for as long as you hold that instrument, I'm storing the grain. So you have to pay me a storage fee. And that storage fee is not set by the market. Okay? So the storage fee is set by the exchange at a fixed level. And so in fact what we show that what happened here is, well, one way to think about it is the storage fee was too low. So differences in capital costs you're going to see are actually really important also in understanding this phenomenon. But it's this difference in the price of storing the physical commodity, this exchange determined price for the pieces of paper that explains the non-convergence. So, the model. I'm going to spend probably about 5 minutes trying to explain this and give an overview of the model rather than digging into all the details, and then we'll do the empirics. So the way we conceptualize this is we say there are three markets. And what I'm going to start here with is just a two-period model. So almost all the intuition and the insights we can get from this two-period setting, and then I'll expand it to an infinite horizon case to get something that's relevant empirically. So we have three markets. A cash grain market, you can buy and sell grain today, you can buy and sell grain next period. A futures market, so you can enter into, and there's a futures market contract expiring today, so we can trade in the expiring futures contract today for immediate delivery, and we can also trade in futures for delivery next period. There are two firms in this market. There's something that we call the regular firm. The regular firm has the right to issue delivery instruments. So not everybody can make delivery in these markets. You have to be approved as being regular for delivery. So in our model here, we have a regular firm. This firm stores grain, it issues delivery instruments, and it has some capital costs that we'll call R. There's another firm that we'll call the financial firm, and this firm is distinguished because it is not allowed to issue delivery instruments, does not store grain, and it has a different capital cost. Potentially different capital costs, at least. So otherwise, these two firms are going to have identical information sets. We're going to assume that they're behaving according to rational expectations and they're behaving competitively. Okay? So the only sort of wedge that we have in here is that we have these two firms that, for reasons of asset fixity or whatever, are operating in these two different ways. So what does the cash market look like? So this is a standard equation for commodity, the price of storable commodities. The price of the commodity today equals the expected price next period. We're going to allow the possibility that there's a risk premium. So we want to subtract that off and discount back to the present at the cost of capital. And then we have some storage components. So delta is, think of that as a warehousing cost of storage. And what we're going to see is a really important component. This Y is the convenience yield, which may depend on inventory. So I is inventory levels. So the spot price of the commodity today is the expected price next period, discounted by cost of storage and potential or convenience yield, which is a part of the price of storage. What about the futures market? So in the futures market, as I said, we're trading today for the immediately expiring futures contract. That market clears, and we have some number of delivery instruments that are going to be issued. And then, so if the regular firm issues some delivery instruments, the financial firm takes those, potentially holds them into next period. And what we're going to assume is that next period, in period 2, those instruments are automatically converted into grain. Okay, so the futures contract that we're trading today for delivery next period, that convergence is imposed on that contract. And what we're going to see is under what conditions do we see that, in fact, today, the price of the delivery instrument, which is the expiring futures price, differs from the cash price of grain. So to dig in there a little bit more, one thing that we're going to add here, so you talk to people in this industry, they say, well, it's really inconvenient for me to issue these certificates and then have some firm just holding on to these things. It's inconvenient. It ties up my facility, reduces my ability to make money from other throughput business. So it's inconvenient for me to have these certificates sitting out there. Okay, so we're including the potential here that there's a cost associated with issuing certificates that just get held. So the regular firm is going to be willing to issue these certificates if these conditions here are true. So on the right-hand side, gamma minus X, that's how much money you make from an outstanding delivery instrument. You receive the storage fee, and you incur the inconvenience cost. So that's how much you make. The cost to you of issuing certificates equals the price that you sell them for. That's the F11, and minus the value of the grain that, so next period, that certificate is going to be turned into grain that's worth the futures price F12 for next period. So that's a condition that says, I'm going to be willing to issue certificates as long as the storage fee is high enough and the inconvenience is not too low relative to the term spread in the futures market. The financial firm is doing the same calculation on the other side, looking at this and saying, if I buy this certificate at price F11, I can take a short position and deliver it back next period. I have to discount that back to the present. As long as the money I make from that exceeds the storage rate, then I'm going to be willing to engage in that transaction. So you put these two things together, the willingness to issue certificates, the willingness to hold them, and when we put them together, we get this market clearing condition that says that certificates are going to be issued if this big equation here holds. And one key that comes out of this thing is if you look at that maximum of stuff equals R minus RF times stuff, is that if the convenience cost is positive, okay, so that X of C, if that's positive, if there's some cost associated with issuing these instruments, then we're only going to get this market to clear if, in fact, the right-hand side is positive. So what happens in this market is to the extent that it's inconvenient for or costly for firms to issue certificates that sit out there and get held, they're only going to actually engage in this business if they're compensated in some other way. And the way in which they're compensated here is essentially they're getting access to capital at the lower rate, the rate of the financial firm. Why are they getting access to capital? They're selling the certificate today at price F11, and then they're delivering grain on that certificate next period at price F12. What's the difference between those two prices? The difference between those two prices is determined in the futures market by the financial firm's cost of capital. So that's the first point here. To get this market to actually clear and have certificates be issued, we need this condition to hold. If there's an inconvenience cost, there must also be a difference in cost of capital, so that the regular firms here are, in some sense, getting access to cheaper capital through this process. So that determines whether the market clears at a non-zero quantity. What about the price? What determines the price F11? Is that bigger than the spot price or the cash price of grain? So again, we put all these equations together, and we get this expression here. So the difference between futures and spot has these two components here. The first component is delta minus y. That's the physical price of storing grain. Gamma is the storage rate on the delivery instrument. So if there's a difference between those two things, the price of storing grain is higher than gamma, the delivery instrument, we're going to see the basis open up. Same thing if there's a difference here in capital costs. And so one more on this just before I move on is a way, I think, to help understand what's going on here. In this model, there are three ways for the regular firm to realize profits from storing the commodity and selling it next period. One thing you can do is you can say, I've got grain, I'm just going to wait. I'm going to see what the price is next period, and I'm going to sell it. Okay? So that's the third term on the very left. What I make is the expected price next period minus the price today. The other thing I could do is I could say, well, I'm going to hedge. So, and I'm potentially risk averse. So the price of storage then would be equal to a risk premium plus the hedged price of carrying grain. So if I enter into a futures contract to deliver next period, that's my price of storage. And those two things have to be equal through arbitrage relationships. The other way that I can deliver grain next period is I can deliver today on the futures contract. I know that the entity that takes that contract is going to hold the piece of paper until next period when they demand the grain. So those are all three equivalent ways in which I can deliver grain next period. If the term spread in the futures market is too low, and the problem in this market is that the term spread in the futures market is capped by the storage rate and by the cost of capital of the financial firms. If the term spread in the futures market is too low to compensate me for the price of storage, I have to make that money up somewhere else. Where do I make it up? I make it up by selling the certificate at a premium. Okay, so the basis reflects that difference. Okay, so that's two periods. So I set up a model where I say everything's competitive, convergence is going to occur next period, and what I see is that in this setting, the price of storage is too high in the physical market, means that the term spread in futures can't get large enough, so I need to be compensated in some other way by issuing the certificate at a premium. So now I'm going to do the same thing at an infinite horizon. I'm going to say convergence is now not guaranteed, and when I do that, what I end up with is something that's almost the same. So this W term here is what we call a wedge. It's a wedge between physical price of storage and the cost of carrying shipping certificates. And And what comes out of this model, when we expand to an infinite horizon, is now the basis depends on what is the wedge today, plus what is the expected future wedges that might occur. So now we're saying the basis, if I, the basis is equal to the present value of all future wedges. If I issue the certificate today and I know you're not going to actually load out the grain until 3 years from now, what matters to me is the accumulated sum of all of those wedges in between now and then, or at least the present value of all of those things. So, so by expanding from 2 periods to an infinite horizon, that's what we end up. So let me now talk about empirics. So what we do here empirically is we can approximate from our theory, we can get an approximate measure of this wedge, as is shown there. We run some regressions. So what we want to do is first understand what is it that explains the wedge. We run some regressions on a bunch of stuff. And in the interest of time, I'm going to talk only about the one at the top because that's the one that matters. Inventory and delivery locations. When inventories are high, price of storage is high, that's when we should expect to see non-convergence. And that's what the regressions show here. So for each of these 3 markets, corn, soybeans, and wheat, we run a regression of our wedge proxy on all this stuff. The thing that really matters is the level of inventories. When inventories are high, that's when you'll see non-convergence. Same thing there. And we do some stuff to try to show that in fact it's not that inventories increase and respond to the basis being high. It's really the other way around. Inventories are driving the basis. So let me show you that graphically as I finish up here. This is the black line there is cash price of wheat since 1990. The little gray parts that are kind of peaking above, that's the expiring futures price. So when did the basis open up? It opened up in 99 to 2001 when prices were high, and we would expect maybe prices were low, inventories were high. When did the basis really open up in 2008 and beyond? It was when prices started coming down from the peak and inventory was accumulating. Okay? In 2006, that looks different, right? That's a case, in fact, where prices were increasing, not decreasing. So, but it turns out that was also a time when inventories were high. Okay? So this is inventories. Where were the 3 peak inventory periods? 99 to 2001, 2007, 2008 to 2010. That's when we saw the basis open up. And I'm getting somewhat short on time. This shows us here an estimate of this wedge term, or the physical price of storage. We can see that since 2008, that black line on the bottom, physical price of storage has been high relative to the dashed line, which is the storage rate. So the last thing I'm going to do, and somewhat quickly so I can finish here, is to see whether, in fact, this present value relation works. So far what we've done is we've said that let me explain this wedge term period by period. What causes this wedge to develop? And the answer is predominantly inventories and deliverable locations. Now we're going to say, well, the actual level of the basis, the difference between futures and spot, should be equal to the present value of expected future wedges if this model works. If there's some kind of bubble component that's in fact driving the wedge, then what we should see is if we add up expected future wedge terms, that we should get the wrong number. So the thing that makes that difficult is we don't observe expected future wedges. But we can do a perfect foresight thing. We can say, well, suppose the market knew the future path. And if the market knew the future path of these wedge terms, what would be the implied basis from that? And we can see whether at least subsequent changes in this thing are large enough to justify the magnitude of the basis that we've seen, which is significant. Up to 35% of the price has been the magnitude of the non-convergence. So that's what we do here, and I'll finish on this slide. The model fits. This is Chicago Board of Trade wheat. Red is the basis, the expiring futures price minus the cash price. We do 2 different things to try to figure out a perfect foresight version of the basis. One, we take predictions out of our regression models. The other one, we use actual sort of realized values of our proxy, and we see that, in fact, this model can explain the approximate magnitude of the basis. So, in summary, It's really all about inventories and deliverable locations. Irrational behavior and limits to arbitrage are not required to explain this phenomenon. So we would conclude that, in fact, the market here can do the math, which is consistent with the fact that open interest and volume in these contracts, especially wheat, that seemed so far out of whack, kept growing through this period. You would think if the market was really broken that people would have started to stay away. So, thank you.
Excellent. So our next speaker is Randy Fortenberry from Washington State University. Recently there. Before that at Wisconsin, which may explain a little bit about the topic being dairy. And he's going to talk about speculative influence in thin markets, the case of dairy.
What we're going to talk about today is actually pieces of two different papers. And the first one sort of motivated the interest in maybe the role of speculators in dairy, and the second paper kind of addresses that. The first one's basically done, but the second one is still a work in progress. So we'll just talk about what we think we know so far and what some of the limitations of that actually are. One thing about the dairy sector is it's very unique relative to other kinds of markets that have a derivative over them. First of all, it's not very old. 1993 was when the first dairy futures contract was actually introduced. This table looks busy, but the reason is this shows all the changes we've gone through in terms of contract design in the dairy sector in this relatively short lifespan. Lots of changes in contract design, both the commodities that actually get traded, what dairy products being traded, how's the contract specified, is it cash settled, physically delivered, where is it going to be delivered if it is deliverable. Many of these changes have happened because of changes in the public policy associated with the management of the cash markets. How do dairy prices get determined at the producer level, and then how do those transmit through the manufacturing sector, the wholesale sector, into the retail dairy case where we all buy our products? All those changes have had strong influences on how the exchanges have had to redesign contracts to try and provide risk management opportunities. So it's a new market in terms of its overall life, but it's also very new in terms of the life of the contracts that are trading today. In fact, early on, these markets were developed specifically because price volatility entered into the dairy sector, and the dairy sector had never experienced that before. The impetus actually came from the commercial side. It was people like Kraft, people like even confectionery companies, people that were making chocolate, and dry milk was a large ingredient. Suddenly there was volatility in that market. They hedged cocoa, they hedged chocolate, they needed an opportunity to hedge dry milk as well to manage their overall margin risk. That's where the impetus came. What's happened, though, is as the market developed, we discovered that some of the design characteristics didn't match what the industry really was looking for. Specifically, initially it was thought, very high correlation between milk and cheese prices, that's true. If we have a cheese contract, that'll satisfy the Krafts of the world who's really pushing to have this market developed, and dairy producers or co-ops that buy from dairy producers can simply cross-hedge milk exposure on the cheddar cheese futures contract. It looks like it should work, very high correlation between those two prices. But in fact, what happened was it didn't work. People weren't happy with the cross-hedge opportunity. This just sort of shows what drove this whole design environment. The light gray line is the support price provided by the U.S. government to dairy producers. So up until the early 1990s, that price was binding. In other words, the market clearing price was somewhere below that price most of the time, which meant there was no price volatility. So on the speculative side, there was no opportunity. There was nothing to trade. And on the production side, there was no real risk to manage in terms of looking for price risk strategies. As that started to change, the interest in the futures contracts developed. And you can see that the volatility, the dispersion between times, has actually grown as we've gone through this last 17 or 18 years. What that's meant is increases in risk exposure, and oftentimes at relatively low margin prices, prices that are barely above cost of production. There were some unique challenges in this market. First of all, we had a cash market with no experience. We had a dynamic public policy environment. I've already pointed those two things out. But in the middle 1990s, just after these markets were developed, there was a large study that suggested that some of the commercials were actually manipulating the cash market. So we had cash market problems. People didn't believe cash market prices in a sense, or didn't believe in the price discovery role of cash markets. The study came out. It was somewhat controversial, but it seemed to verify some of those concerns. And the result is we had a large change in the way the cash market happened. The cash market for cheese used to be in Green Bay, Wisconsin. It only traded on Friday for a couple of hours. Only about 0.5% of all the cheese traded in the U.S. went through that exchange directly, but everything else was priced off of that exchange's price. So it became a reference price for cheese trade. If that was being manipulated, then dairy producers thought they were being enfranchised from the market, and there were concerns about what the real price should be. The exchange moved. What happened was, I think the Federal Trade Commission and the state of Wisconsin funded the study, so the response was, let's move the exchange from Wisconsin to a different state. It's now the Chicago Mercantile Exchange. It behaves differently, but it's still a very thin cash market. It now trades every day, but for a very short period of time, and it's still a very small percentage of total cheese that actually gets priced there, yet it's the reference price that prices almost everything else that gets traded in the broader market. The other thing that happened, and I don't think this had happened since the 1950s with wheat, as we developed these cheese contracts, we had head-to-head competition between two different exchanges. What was the Coffee, Sugar, and Cocoa Exchange in New York initially, and then the Chicago Mercantile Exchange came in, and their contracts were very, very similar, virtually identical, which meant we were taking new markets with relatively thin trading volume and trying to take that small amount of risk capital and move it to two separate markets. So we had a thin market problem that was exacerbated by the opportunity to trade in two different physical locations. This was the study that came out. It was by Fritz Mueller and Bruce Marion. The biggest conclusion was that Kraft was somehow manipulating this price, and what happened was volume on the futures exchange dropped precipitously. In fact, if we look at cheddar cheese open interest volume, it started dropping before the report even came out, but once the report came out, nobody believed in the cash market or the futures market, and we had a real problem with thinking about how the market should be structured. Market moved to Chicago, futures started trading again. One of the first studies that was done in these markets was done in 1997, and we were looking at whether or not we had developed a relationship between cash and futures once we moved the cash market that provided a stable basis relationship. Could we look at could we look at futures going forward, implement a hedge, and have a reasonable expectation about what the cash price was going to be? What we found initially is the market wasn't providing that kind of an opportunity. And we looked at that relative to other thin markets. Diammonium phosphate was one which was trading at the Chicago Board of Trade at the time. And we found that in those markets there was a stable cash futures relationship. So it wasn't just a function of being thin, but thinness certainly didn't help. It probably was still a function of uncertainty about what was really being priced in the futures market and the overall performance of the cash market that had just moved to Chicago. Later, we went back and said, what would have happened if we'd had a milk contract instead of a cheddar cheese contract? If the milk price is $12 per 100 pounds, that's about $1.20 per pound cheese price. They're very highly correlated. In fact, from 2000 through this year, the correlation is about 95% between those two prices. So we said, what if there was a milk contract? Would we have had more volume? We sort of simulated what a milk futures would have looked like, and concluded that, in fact, that would have been a better contract than the cheese contract. What ended up happening was a milk contract was developed. The cheese contract was eventually dropped. I should say Cam Thrain at Ohio State, though, came back 2 years later, 1999, and said, the problem with Fortenberry and Zapata is they weren't patient enough. If you waited for 2 more years, the cheese market did develop a stable basis relationship. The futures was providing risk management opportunities for cash market participants. Right after that paper came out, they delisted the cheese contract. If you look at open interest, you've seen this chart for a bunch of commodities, but here's dairy as well. If we look at open interest relative to price, we tend to see this positive correlation. Open interest goes up, price tends to go up. What happened was in 2000, we developed a new milk contract representing new policy in the cash market, and that contract is still around. So all of a sudden, there wasn't a lot of interest in this market. The public policy environment got a bit more stable. The futures market was being used, and we didn't get a lot of interest until this period when everybody got concerned about everything in 2008, 2009, 2010. And specifically what happened is we got concerned about whether or not increased volatility in milk prices and or biases in the futures price for milk for later delivery were being driven by speculative activity in the futures market itself. So we have a thin market, unlike oil, and we have speculators, and the question is whether or not they represent too large a part of this market, and if they happen to be technical traders or index type traders or noise traders, whatever you want to call them, whatever their motivation is, they're not paying attention to the fundamentals. Are we destabilizing this market? If you look at the commercial open interest, I'm going to just give you a little anecdotal evidence first, though. Here's the commercial open interest. So these are people that are primarily hedgers. Now, we already know from other people's comments that that's not completely true. Some commercial reporters actually take speculative positions. But it's a very large percentage of the overall open interest. And if we break it down by longs and shorts, commercials dominate the long side of this market and have through this period of relatively increased price instability. If you look at the short side, it's not as big, but it's still a huge percentage of that market. If you compare that to something like corn, where the speculative percentage of open interest has been rising over the last 3 or 4 years, dairy's very different. So just sort of anecdotally, if I look at that, I think, well, there might be problems with the pricing, but I doubt if it's being driven by excessive speculative influence because, if anything, they seem to be a smaller percentage of this market than some of the other markets we might be more familiar with. This is the class 3 futures price, though, that people were worried about since we started trading it in 2000. And you can see large swings, $21, $9, that's per 100 pounds. A contract is 200,000 pounds. But that's a big swing if you're a producer. If you talk to producers today, I don't know if they're right, but they'll tell you their break-even price is $15.50 or $16 per 100 pounds. So you can see we spend a lot of time below that break-even price. They're very concerned about price levels as well as volatility. So the first thing we asked was, is there a bias in these futures prices, regardless of whether speculators are driving it or not? What you're looking at here is a picture of every contract that has traded since 2000 up through January of 2011, and the dispersion by days to maturity. So the contract is approaching expiration as we go from the left to the right on this diagram. You can see that there's a large dispersion. Sometimes the futures price is well above where it ends up converging towards the end. Sometimes it's well below. For this particular market, the futures has to equal the cash price when it expires. It's cash settled against a USDA announced price. So it comes to zero. The heavy black line, though, is the average across every one of these contracts. So you might look back towards 330 days out, year and a half, and you'll say, well, there's a slight downward bias. The futures price is under-predicting on average where the cash price is going to end up. But as you get to be within about a year of expiration, that mean is about zero. So it doesn't look like there's a price bias, at least in my opinion, relative to this market. It doesn't seem to be over or under systematically forecasting what the actual settlement price is going to be in terms of the cash market. But what about volatility? This is what got people really heated in the beginning of the 2008 period. Research has shown that for storable commodities, and Aaron's done some of this work, price variances across contract months are heavily influenced by a common factor. In other words, as we look across different delivery dates, on a specific day, we watch price changes, and there's a common factor driving a large percentage of that price change. For milk, we find that that's not the case. We actually employ a model that Aaron first presented in 2005, called a POTS model, partial overlapping time series model. What it lets us do is disentangle the information in each individual delivery period. Normally when we construct a nearby futures contract, we have one time series and we're explaining everything that's happening with that single price. This allows us to look across different prices and ask what happens as we measure those different prices. And here's a couple of interesting diagrams. First of all, unlike corn and other storable commodities, the unconditional standard deviation of these contracts falls as we approach maturity. And it starts to fall very rapidly up to 2 months before expiration. Now, if speculators are trading in the nearby contracts, the more liquid contracts, and they're destabilizing the market, this doesn't seem consistent with that story. And in fact, the last 30 days, it kind of makes sense because this is a survey-generated cash price, and we know a lot about that survey data 3 weeks before we actually get the announcement. But this starts a full 2 months before the actual expiration. The other thing we can see is that the proportion of the variance, what this Potts model lets us do is say there's an idiosyncratic factor that drives part of the variance of this price series, and then there's a common factor driving all the delivery months. What happens in our case is, as we approach expiration, even 4 and 5 months out, each individual contract month is becoming uniquely driven in terms of its variability by an idiosyncratic factor. The same factors aren't driving it. Again, if we thought speculators were driving these markets, and they're rolling from a nearby to a second nearby, or a second nearby to a third nearby, and or they're trading spreads, I wouldn't expect to see such a large diversion from a common factor explaining all the price movement on a given day. That was our evidence that helped us think about what should really be measured in terms of the cheese price. Here's the problem with these markets. The cash milk market doesn't exist in the sense that the futures contract's trading a transacted cash price somewhere. It's a survey of a bunch of prices that gets reported. The cheese market has a cash market, but it's very thin. It doesn't trade a lot. The cheese futures contract that we trade today is only a year old. So we didn't have much data to really look at this issue. So what we did is constructed a synthetic cheese futures price based on the milk price, converting it to skim milk, taking out a butterfat price. There is a butter futures contract. We can use that. Taking out the whey, the other solids, and saying this is what the cheddar cheese futures price would have looked like if it existed over this period of time. Then we run a bunch of VAR models with Garch error structure and try to ask, what are the volatility spillovers between these two markets, and what drives price? Here's what we actually find with a whole bunch of different models based on how we measure the futures price. But volatility spillovers are bidirectional. They're going from cash to futures. Most importantly, though, the increased levels of speculation do not appear to drive increased volatility. Now, this is synthetic data, so we're not quite sure what that means. The next step we've kind of taken is calculating, going backwards 50-some years, Working's T. Working introduced this concept in 1960. The idea is to look at the total hedge positions. That's in the denominator, hedgers short, hedgers long. The speculative position, if hedgers are net long, we want to have the speculators total short in the numerator, and ask, what's that ratio look like? This is measuring sufficient, if you want to think about it that way, liquidity through speculative activity. Irwin and Sanders in 2010 suggested that a reasonable number, or a lower bound number for reasonable amounts of speculative activity is about 1.15. When we look at ours, and what these different things are measuring is how we deal for non-reportable traders, and I'll explain that in a second. But you can see that on average, we only have 1 or 2 numbers much above 1.15, and I'm not sure they're statistically different. Many minimums down near 1. Maximums sometimes up over 1.5. Proportional means we took the non-reporting traders and said they look just like the reportable traders. So if 80% of the commercials are net long, then 80% of the non-reportables that are long are commercials. Upper bound is something Ann Peck had done a long time ago. Let's make all the non-reportables on one side of the market or the other, so we have an upper bound or a lower bound. Dynamic is something we did that said, you know, if we do the proportional and all the large commercials are net long, but we find almost all the non-reportables are net short, then we don't want to balance them based on the commercial reportables, non-commercial reportables. They're on the opposite side of the market. But it doesn't really matter how we deal with these things. The S means we added in the spreads. When Working did this, he didn't look at spread trade, but we went and teased out the spread positions of all these traders as well, and again, it doesn't seem to matter very much. So what do we think we've learned? Well, a couple of policy strategies. First of all, if we're going to do margin exposure, which was talked to earlier, especially in the, in fact, the ethanol example was referred to, we need to think about strategies outside of these markets. Thin markets make it expensive to hedge. Volatility makes it expensive to hedge. Margins tend to increase when volatility increases, and margin calls are a problem. In the dairy sector, we're talking about a lot of smaller scale operators on the hedging side, small milk plants and cooperatives. One of the results of that has been a development of the livestock gross margin insurance, which is actually looking forward at the options markets for inputs, corn and soybean meal primarily, and milk prices, and designing a insurance policy based on the prices of those option premia out there. So that's one way to react to it on the policy side. The most important thing, though, is this last point, regulating market directly. What happened with this market, like many others, is when we started to experience the volatility, there was a lot of pressure to come in and look carefully at speculative activity and think aggressively about regulating it. If anything in this market, the problem is there's not enough speculative activity to make it liquid and keep large jumps across transactions from taking place. There's also huge issues with the way the cash market is designed and the way the futures market links to that. So there's a couple conclusions that I think we come out of this with. Price volatility does make it difficult to hedge, but sometimes we're going to have to find alternatives that might be futures-based but don't expose everybody to the futures market directly. Futures cannot solve cash market problems. And this is a sector that's had, maybe they're not always problems, but cash market issues as we've redesigned how the cash market is organized and how it actually gets priced. Futures can't do anything to solve that problem. And so taking speculators out or limiting positions or forcing people to liquidate positions as we approach expiration doesn't do anything to the cash market participants that really have structural issues associated with the way their cash market operates. Perceptions of cash market discovery are critical to the futures market being accepted. What all that, I think, means is markets are very unique. There is no one-size-fits-all policy. This is a market that when we look at it from the outside has a lot of the same problems the markets that we talked about yesterday and today have, perceptions of excessive volatility, but the dynamics of the market are very different and the policy instruments need to be tailored to the specific uniqueness of these individual markets. Thank you.
Brian Wright from the University of California at Berkeley will speak on the economics of grain price volatility.
Thanks, Sally. I'd just like to put my talk in a little bit of context. When I first started addressing this issue back in 2008, I referred to some work that I'd done on econometric estimation of these markets and some other work on numerical modeling. The more I talked about this to more diverse groups, all of which included many people very interested in these questions, the more I became convinced of the need to put the thing in a factual context. And so the talk has basically diverged from being mostly economics and some econometrics to being mostly facts. And at least facts as I see them, but it seems to me it's easier to discuss whether the facts are right than whether the economic theory is right. When you get the facts right, maybe you can make some progress on everything else. Okay, I just put up always 2 slides. Having seen Inside Job, I thought I should probably list my sponsors. So here are my current grant support list. And here's my current and recent consulting relationships. And if anybody wants to ask me...
It's not showing.
Oh.
It's not projected.
Oh, something's wrong. So I'm talking about them as if I'm showing them to you, but I'm actually hiding them. That's pretty cute, right? Here we go. So there they are. This is one slide. This is the other. I don't want to waste time on it, but anybody wants to ask me about it an hour later, I'll be happy to. I think all economists should do this, like the medical profession does now in many cases. So when I started talking about this, there was a blame game going on. What's causing the grain price volatility? And by the way, all my remarks are about grains. I think oil is a very different thing. For a start, it makes me really nervous when I think about oil because I don't quite know what the inventory is. Is the stuff above ground, below ground? Is it being controlled by a monopolist or is competitive? It's very hard to sort all that out. Grains are a little simpler. So was it the price of crude oil? Was it China's consumption? Was it US and EU biofuels policy? Was it a bubble, greedy speculators or broken financial markets and such things? And people would allocate different amounts of blame to each one. There was a famous paper from the World Bank by Mitchell that allocated a certain amount of blame to biofuels, for example, and other people argued about those numbers. So as I said, having talked about this and met lots of people, I thought it's good to start with going over the received wisdom. And the received wisdom, as many people have presented it, and somebody at a meeting in England earlier this year presented almost all these points. In 2008 and currently, we've had the CPI deflated price spikes in major grains at levels not seen since the early 1970s. Secondly, recent price spikes were associated with the largest harvest shortfalls since the 1970s. Third, higher energy prices led commodity prices, as in the 1970s and in other major commodity booms. 4, higher energy prices caused higher commodity prices. 5, climate change is reflected in recent increased harvest volatility, which is being reflected in the price volatility. And 6, price spikes are related to growth of the middle class in certain economies like China and India, where consumption has increased directly or via increased feed demands for cattle and for chickens and other things. 7, the 2007-08 food crisis was, as a major Washington-based food policy institution has claimed, a perfect storm in grain markets, the worst possible situation. Okay, so my presentation, as I said, is mostly about some of these facts, and then a little bit of theory about storage arbitrage, which does have relevance to what's being discussed today. And finally, I'll talk about the implications for policy, whether we should be controlling speculators or whether we should be doing something else. Okay, so first of all, in 2008 and currently, we've had the CPI deflated price breaks in major grains at levels not seen since the early 1970s. Now, I think a lot of people in the audience should know whether that's true or not. I'll just show one picture. I don't think so, because nobody of 500 people in one international organization had remembered that the grain price was high in the maize price, deflated US dollars, was higher in 1996 than it was in 2008. As this diagram shows, nobody remembers that because other things weren't happening in 1996. And neither of those are, and then there are other fluctuations also. Recent price spikes were associated with the largest harvest shortfalls since the 1970s. Everybody knows that the period between 73 and 75 is a period of tremendous turmoil, and everybody recalls how big those harvest shortfalls were. So let's first of all see how big those harvest shortfalls were in the 1970s. And I can now show you a graph of year-to-year changes in harvests for major grains. And it's a little bit hard to find those big shortfalls in the 1970s. Where are they? Is it that part in the middle of this graph? The 1970s, the period we're talking about, is right here. There was actually very little decline in the harvests of the major grains in the early 1970s. There were big declines in the middle of this graph. Nobody remembers them because there weren't big price rises at those times. Look at the right-hand side of the graph and see those big harvest declines we've had recently. It's basically flat, not very big declines. 3, higher energy prices led commodity prices, as in the 1970s and other commodity booms. A lot of people have said this to me quite confidently because everybody knows it, right? So here's a picture of 3 big booms: Korean War, oil shocks, recent booms. This is from the World Bank. Notice how energy has been driving all 3. Energy is the green line, okay, the oil price. Back when markets were properly controlled, nothing was happening in the oil price in the Korean War boom. In the second boom, obviously energy was leading, except it was about 6 months late. Many people have forgotten the first commodity embargo of the 1970s, which was soybeans, right? Well before energy started taking off. So energy gets 1 out of 3. Look at metals. Metals is obviously a big participant in these booms, except it isn't, is it? So just beware of this confident received wisdom that many people say. I'm sure there are people in this audience who are well aware of these problems, but many people have said these things. Higher energy prices caused higher commodity prices. Well, we just saw that that can't be true in most of these booms because it's too late. Now, a lot of people are now claiming that, and especially farm groups are claiming, that the high food prices are due to high energy costs. Well, I'm not going to dwell on that, but if you think about that for a minute, if you've got food production that's not declining, then that can't be true. And there are some simple supply-demand graphs that will show that, but since I'm short of time, I won't show them unless somebody asks me a question about it. Now, here's an interesting one. This was stated by a fellow of the Royal Society in an English meeting. He had been chief editor of a very large and influential report on food prices, and he said that climate change is reflected in recent increased harvest volatility, and that's causing food price fluctuations. Well, I'll show you next just year-on-year changes in the production in the world of the major grains as best they've been estimated. And here they are. So there are almost none until this year. Things have changed. This stops before the very latest news. But you can see that if you look for big year-on-year harvest fluctuations, I think what you'll want to look at is maize about 1983. That's when we really had some action. All the action in this graph is in the middle, not at either end. It's not in the early 1970s when we had the other huge, much bigger increase in prices, and it's not happening now. Okay, unanticipated increase in pork and beef demand, and maybe more relevantly chicken demand in India and China is very important, according to many people, and it's very plausible. India and China's rate of income increase is just unprecedented for so many years. And I kind of believed this until I looked at what people claim are some of the reasonably accurate among a very inaccurate set of data. And this is a table from FAO. Oops. And this shows that GDP in China and India indeed was increasing between the period 1997-2002 to the later period on that on this table. But look what's happening to beef demand. In China, it's slowing. The rate of increase is slowing down. In India, it's negative. India are not, of course, the last of the big beef eaters. But then pork, the same kind of thing in both countries, slowing demand rather than increasing. Chickens is increasing. In China, not increasing as fast as it was before. In India, slowed down also, but don't get too excited by those Indian numbers because we've got a very small base. Basically, China eats a lot of meat, India doesn't. So this is not the story of some kind of shock starting after, say, in the period around 2006, 2008 that could have shifted these markets. Okay, so 2007-8, it should be clear now, and the recent period are not really the perfect storm in these markets at all, especially the earlier period around 2007-8. There were not really very serious production shortfalls at all. I'm going to skip this one. This was a sort of an addendum that one of my friends at the FAO showed me because people also claim that what's really going on is Africa has reached a kind of plateau. They can't get any technical change out of their agriculture, and that's causing people to starve. Well, this is the USDA graph of African yields. It looks to me like there isn't really a problem of slowdown in yields in Africa. They may have many other problems, but not that one. Okay, so the summary of what we see is that changes in levels versus and changes in price spikes. They're two different things. They're related. 2008, it was really a start of a spike, but then there was a bump up in levels. They're two different phenomena with somewhat different policy implications. The price spikes do not match shortfalls in production. No evidence surprising faster demand growth in China and India. No evidence of increased climate volatility reflected in the production or the price numbers. Energy costs do not explain price spikes. By the way, when I mention no evidence of climate volatility, there's certainly many more newspaper reports about it. It just doesn't happen to get reflected in the data. We haven't seen anything even close to a worst case scenario in food prices. It could be much worse. So what are the real causes of this change in volatility? And one of the arguments has gone, well, you can't explain it by any of the real phenomena, so it must be the speculators. Often then that argument stops in. It stops short of showing how that could be true, but it's obviously true because nothing else could be causing it. So is it speculation or is it something else like bioenergy? So to understand this question and to comment on it, you've got to know a little bit about storage arbitrage. Everybody here knows about that. This next slide is as technical as I get. Basically, it is what your mother told you, buy low, sell high, right? If you've got stocks, sell it when it's high. Okay, this is the technical graph. I and my colleagues spent some time estimating these things from real markets. We've shown that Angus Deaton and Guy Laroque's work showing that this couldn't be done is actually wrong. We have a paper in the Journal of Econometrics a few years ago on this, which is at the end of this presentation. But the important thing to understand about this is that the red curve is really different from the blue curve. The blue curve is the curve augmented by stocks. The red curve is the consumption demand curve, which you get which is from human and animal consumption. And when you add the stock demands, it makes the market demand much more elastic. So anybody who does linear models to analyze changes in volatility is going to be out of luck in grain markets, because there's a huge nonlinearity due to the storage arbitrage relation, which only kicks in to a significant degree below some level. So don't think linear models, it's not going to work. And notice that a shortfall in production of the same size will have a very different effect on the left than it does on the right, as I've shown there. You can't understand these markets without understanding that. Okay, so storers smooth out peaks after unexpected shocks if they have stocks to smooth them out. When the stocks run out, you need price spikes high enough to get consumers to actually cut back their consumption enough to stabilize the market. There's no other way it can work. This is the theory. Is it true? Do spikes occur only if stocks are minimal or not? It's a plausible theory. Let's see if we can show whether that's true or not. This is the May's stocks-to-use ratio. Two different lines. A red line, which is the world without China. The blue line is the world with China. Now, I already showed you maize production and other grain production and showed how that didn't correlate with price peaks. I won't spend time doing this, but you can notice that there are troughs in the red line around 72, 75, another one about 83, another one about 91, another one about that 96 period that I mentioned before, where the corn price was high. And then more recently, but there's one also in 2002-03, which did not get reflected in large price spikes. And that's because this is where the Chinese really got into action and sold off a huge amount into this market. And the Chinese basically prevented chaos in the corn market in the early 2000s. Apart from that, if you want to know where the spikes are, you look at this graph, you don't look at the world production graph. Okay, so I'm going to skip that. But the implications of this nonlinearity are really important, because it means you can't play the blame game adding up percentages of brain. It's a nonlinear function. Therefore, you can't say 10% is this and 20% of that, because it's the last 5 or 10% that causes all the chaos. You drive the stocks down to a very low level, and suddenly you get this very inelastic demand, making even tiny little pipsqueak countries like, for example, just to pick one at random, Australia's drought will cause havoc in the markets when you have no stocks. Because once you've got no stocks, you're naked before this, and every price movement, especially in rice and wheat, has to be met by somebody not consuming, and that's very hard. What would the price have to be to stop you consuming your muffins in the morning? Now, so I've used this technical literature to explain this nonlinearity. I got this from my kids. It's a story called Who Sank the Boat? It was used by the Kentucky School Board to illustrate the principle of displacement of water. What it actually illustrates is nonlinearity. What happens when the mouse jumps in is the boat sinks, okay? So how much of the blame comes to the mouse? That's the Australian drought. And how much comes to the pig, or whoever got in second, say, and was a bit of a surprise? Keep that in your head. This tends to be the slide that gets referenced out of this talk, by the way. Okay, this is what drove this market crazy, in my opinion. This is the ramp up. I've just rescaled a USDA report showing the successive ramp ups of predictions of biofuels demand starting around the Bush policy change around 2006, 2007. And this is an enormous change. It meant this. The blue line is US maize available for food and feed. The green line is the availability for food and feed less bioenergy demand, okay? And I've taken account of the byproducts that go back to animal feed. So this is the actual difference. Notice something very interesting, that the latest point on this graph is actually lower than the peak in 1994 in the green line. So all of the increase since that peak in 1994 has been taken account of by biofuels in US maize. If we'd told people in 1994 there was going to be no increase in availability from this point up until 2011, do you think the markets would have moved? I think so. So, also, I'm not going to talk about soy and oil seeds, but you have a similar, though less dramatic, change there. This large unanticipated demand bump caused stocks to fall to very low levels in the feed grains, and that then bled over into wheat, which became more of a feed grain, and it bled over into rice for complicated reasons about substitution of rice, wheat, and then sugar in the sugar market, because India started importing a large amount of sugar when they ran short of sugar supplies because they transferred so much of their land to grow rice in response to the rice spike. So with these low stocks, the prices were very highly sensitive, and these low stocks have to be measured not relative to current use but anticipated use, because biofuels were known to be ramping up year after year. So it's not the current, but it's really the anticipated stocks-to-use ratio, which will be even more dramatic in this. US has about a 25% share of these global grains markets, so what happens in the US really does affect the rest of the world in these markets, especially as some countries were cutting off grain trade across their borders and making the rest of the world market effectively smaller and smaller. What we have in the US is a biofuels policy, which is really a new version of an old kind of agricultural policy, price discrimination. You take a product from an inelastic market, like consumption demand for food, and put it on another market which has an elastic demand, like fuels, where the biofuels is a very small part of that market, so it has a very large elasticity, and you make farmers richer, and you effectively put something between a 20 and 100% tax on global poor food consumers. I don't want to overemphasize that, because a lot of global poor consumers don't pay the world price. They get protected from it. But nevertheless, this is what's going on, a wealth transfer into the United States, largely from poor consumers, because most of the world's grain consumers are poor. Somebody mentioned previously that the large difference between the cost of the commodity and the price of the food means that consumers don't get affected like they used to. Well, that's true in the US, but it's not true in many other countries. So that's what's going on. And are speculators causing this problem? The same kind of arbitrage language can help explain this question, and it's simpler than it is in oil. Because if speculators caused this problem, stocks would have rose when they actually fell. You wouldn't get the spikes at exactly the lowest point on stocks. You'd have to argue, in fact, we're not seeing the stocks. There's somewhere where we can't see, they're hiding them. Disappearance has been manipulated. I think it gets to be very implausible. In oil, it's a bit more complicated, because they might be storing by monopolistic and manipulating production, and that's a different issue, and it's a harder one to think about. Nobody seems to have a good model of OPEC and all those decisions. The problem is there's been a regime change. It's one that farmers like, at least grain farmers like it. They're politically powerful. I believe that their main job, lobbying-wise, in the next several years will be to keep this program in place, to expand ethanol consumption, to keep the price floor about where it is now. And so I think, and if they do that, you won't get a reversion to the old equilibrium prices. Developing countries are talking about doing the same thing in some cases, which could only make this problem worse if they do it. This could be quite rational economically for farmers and even for investors in general if the oil price stays really high, but it'll be very unfortunate for poor food producers. It will be a much bigger transfer than any amount of aid could possibly achieve. So it is an interesting and important moral question, I think, for the world at large, how we handle our biofuels policy in this country and other developed countries, and how we advise poor countries to handle their biofuels policies too. Some people have said, well, the problem here is that we restrict use of genetically modified plants, etc., and if we only didn't do that, production would catch up. At its height, biofuel demand was increasing more than 16% a year in the United States in the maize market. There's no way that even the most brilliant scientists can make yields increase at anything like that rate. If we're talking 2-3%, maybe. But you can make demand increase by diverting into the energy market faster than any amount of technical change can get you to catch up. So the main story here is we didn't need speculation and broken commodity markets to explain what was going on. This is a real story that's been going on. I'm not talking about day-to-day movements, but season-to-season movements. And the real story is you had a large new demand which bumped up very substantially the total demand in the traded world and couldn't be caught up with and hasn't really been caught up with by expansion of stocks because that demand's been been ramped up over the last 4 years successively, and then the high oil prices kept it very high. So, so the message for here is that, and it's one I think that echoes some other messages earlier today, that whatever's going on in financial speculation is not the major story in grain commodity markets with respect to effects on global food consumption. Thank you.
Very nice, thank you.
These are my colleagues who helped me, and there's the reference if you need it.
And Andre, the papers, presentations will be available on the CFTC website? Yep. Okay, our final presentation is by Wei Zhang from Princeton University, who will speak on the seismology of commodity futures markets.
Thanks. It's a pleasure to be here. Actually, I'm just going to present the paper. Actually, it's a preliminary version of some result of a paper I joined with Yinho Chen at Michigan and Andrei Kirilenko of CFTC. So given Andrei's affiliation, I should mention that this usual disclaimer, this presentation only reflects our own view, not any of the CFTC. The motivation of this is about, of course, sort of the significant change in commodities market in recent years. We have seen increased correlation between commodity futures prices and also increased correlation between stocks and commodities, and also episodes of large price volatility. All this caused, of course, anxiety in the public and as well as in the policy circle about anything changing in this market. In particular, we worried about the potential impact from financial investors like index traders and hedge funds. We have been through many talks in this conference so far. Discussion has been very good. We have seen argument from both sides. It's clear that the evidence is inconclusive. We also had some very nice presentation earlier this morning. Jim Hamilton gave a very nice talk about sort of what should be the right language thinking about this. I think we all agree that eventually fundamental demand and supply determine the prices, right? But then there's a horizon issue. What the horizon are we talking about? Of course, 1 year or 2 years down the road, prices must be determined by supply and demand, right? But given sort of important role futures market play in information discovery, over the short and medium run, so lots of things can happen, right? So we need a precise measure. What's the effect coming from the financial side, right? Is this just a pure sideshow, or there's something more significant? So far, I haven't seen any sort of conclusive, measure from either side. Well, not to say I don't believe sort of, there could be a sideshow, but I will argue it's also very hard to argue from the other side, sort of financial market is purely a sideshow. I think evidence is not clear from either side. So that's sort of what we want to talk about. Hopefully sort of is about can we come up with more conclusive evidence, okay? Of course, I can't go that far here today. So what I'm going to focus on actually is some recent phenomenon, so reflected in this figure here. 1 year rolling correlation between stocks and the commodities. One can see that for large part, from late 80s to now, for large part, over the period, the correlation is very small, if anything, negative. Okay, so this is the Gulf War, of course, supply diminishing and oil price rocketed because of the Gulf War. But during this quiet period, the correlation is really very small, if anything, negative, right? But suddenly, somewhere in 2008, in fact, this is right after September 2008, the correlation jumped up. So this rise in correlation is puzzling in many ways. Well, one easy argument would be, well, this could just be fundamental, right? Of course, when stock market are moving down, we expect commodity price to go down as well, right? But on the other hand, it's puzzling why during this sort of normal period, there's no correlation at all. And in fact, the negative correlation, right? You know, when uncertainty goes up, you expect the common fundamental become more important. But if that loading is negative, we shouldn't see suddenly rise sort of positive correlation, right, to this magnitude. Right? So in fact, this correlation I put here is very consistent with many others have seen, like Michel Robb and Bahatin have shown in their studies. So the question sort of here is that, well, what drives the sudden sort of rise in the correlation and so on? So many would argue sort of that what happened in 2008 is a crisis, is an earthquake in the financial market. So how did this happen? How did this sort of shock the commodities market? This is sort of what we are trying to sort of look into. Okay, so looking from outside, the commodity futures market is like a black box, right? It's you know, it's zero supply. You know, how should this really? I mean, I think it's understandable from a standard theory perspective. Well, it's zero supply to the extent they should, if any shock to the futures market affect the sort of real prices, must be affects sort of a fundamental supply and demand to some extent, right? Otherwise, how should this have a persistent effect on the prices? You know, to identify this, I think it's potentially useful. Let's look into the box, right? So we got all kinds of participants in the market, index traders, hedge funds, commercials, and others, and so on. So how did all these guys react to the shock? You know, in the end, we know their positions have to add up to zero, right? Market has to clear. But on the other hand, there are many questions we want to understand. Is this a common shock? And how is the shock sort of transmitted through the supply and demand of different groups? So this is the sort of questions we want to address. Hopefully by doing that, we can identify, first, questions like who transmitted the shock and who is the absorber and so on. So here is the approach we're trying to propose, the so-called seismology approach. We want to understand how different traders react to outside shocks and what are their roles in transmitting or absorbing the shocks. So actually, from econometrics perspective, this is very much the instrumental variable approach. So the econometricians have been playing for a long time. So on the other hand, here we focus on differential responses from different traders. So to an outside shock. Hopefully, sort of we build on this idea through the differential responses. We can say something about the different roles and also some quantitative assessment of their roles. Okay, we argue this approach can help sort out a potential mess in the endogeneity of traders' position. So this issue had come up yesterday in the discussion. We know if a trader involved in the trade, he could get into the trade for opposite reason, right? One is he has his own reason to trade, he wants to buy, which end up driving up the price. So of course we expect a positive correlation between his trade and the price, right? On the other hand, this trader might be actually step in response to somebody else's trade. And somebody else's trade is driving up the price, then this trader is selling in response to that. So in this type of trade, we see actually a negative correlation between his trade and the price change, right? So if we average over sort of these two types of trades, so this particular trader's position change and the price change could be indeterminate, right? Could be positive, could be negative. Really depends on what kind of trade he's doing, right? So by focus on sort of a response of different traders to the same shock, hopefully sort of we can sort out this endogeneity issue in some ways, okay? Here's a conceptual framework. So we consider a market with n groups. The demand of each group is dx is a demand change of a particular group. So here's, this group has a downward sloping curve, okay? So df is the price change. Beta I represents this group's absorption capacity. When price rise, demand will go down, right? Z here represents a shock from outside, like the earthquake I mentioned earlier. Gamma I is this group's exposure to the shock. Of course, gamma I could be positive, could be negative, or could be zero, okay? epsilon I here is idiosyncratic demand for the group. Okay, so it's probably useful to consider, the distribution of the exposure to the shock is important to us. So of course we could see all kinds of potential distribution across population in the market, right? It's probably useful to focus on two types of distribution. One is two polar cases. One is a common shock with uniform distribution. That means the exposure of each group relative to its absorption capacity is constant across all the groups. That means the shock hits everybody equally relative to their absorption capacity. Another polar case is this could be an isolated shock with only concentrated impact on a particular group, say group 1. So its exposure is gamma 1, say positive, and the other group has no exposure at all. Okay, so then naturally sort of this group will become a transmitter, right? Okay, so this would be sort of an ideal sort of an IV kind of situation. We may or may not have this luxury, but hopefully sort of as long as there's some dispersion across different groups, we can still see something. Okay, it's easy to sort of given the exposure, it's easy to compute the clearing price. So the net price change in the market will be determined by the aggregate exposure of everyone divided by aggregate absorption capacity in the market, right? So this is obvious. It's useful to focus on actually on individual groups' reaction to the shock. Okay, so we can sort of substitute in the price to get this. So for group I, so its position change depends on gamma I, of course. This is exposure, right? But there's also an indirect price effect, right? When price rise, the group will demand less, even though it has positive exposure, right? So this second negative term here basically is the indirect price effect, reflecting the situation when price rise, demand will come down, okay? Now let's go back to the two polar cases. In the common shock case, everybody gets exposed to the shock the same way, right? So it's obvious in this case price will rise, but the actual position change is going to be zero, right? Because everybody wants to buy, so no one wants to sell. Price will rise. No contract change hands, right? Okay. Another polar case is a little bit more interesting. How about the polar case, the isolated case? The shock only hits group 1, okay, and no one else. Then price will move, right? Okay. And then, of course, the group 1 will buy, but how much it buys is actually slightly less than what its own shock, because price will rise. So given that downward sloping curve implies his actual position will be a little bit smaller. But the other guys, the other groups in the market have to respond to the shock, right? Respond to the price change. The other guys in the market will step in, take the other side. Okay. Based on sort of this distribution of position sort of across different groups in response to the shock, we can actually use this to identify, well, how about the potential transmitter? So it's easy to do this in a two-step procedure, right? First, we request each group's position change on the shock to estimate the response in position from, say, group 1 to the shock. Then we request the price change, the observed price change, df, onto this group's response. We get the coefficient L1 here, right? So this is actually pretty much the IV kind of analysis kind of thing. So direct algebra shows that a test of L1 larger than 0 is equivalent to test this group's exposure to the shock relative to its absorption capacity is higher than average. That means this group will be the transmitter in the market. Okay. And also, the coefficient can be used as a potential measure of the group's market impact, or which is equivalent to everyone else's absorption capacity in the market. Okay, because how big is this group's price impact depends on how much the other groups can step in to absorb the trade, right? Okay. This actually, how precise this estimate is, of course, depends on whether other groups are exposed to the shock, right? In the nice case, if actually the shock is isolated, only group 1 is exposed, then this measure will be exactly everyone else's risk-bearing the absorption capacity. Okay, but if other guys actually also had some exposure, then this measure will be overestimated. Okay. But at the minimum, we can use this to test whether this group is a transmitter. The same thing, sort of, we flip around, we can identify who is an absorber, okay? Again, sort of a two-step procedure. So if we request, say, another group I's, look at the group I. We first request the price change on the shock, find out the price reaction to the shock, then request this group's position change on the price change. So we get another regression coefficient, which will be negative, right? Basically, we are testing sort of this group's demand curve response, right? It's easy to see that, well, minus K1, test whether minus K1 is positive or not is equivalent to test whether this group's exposure to the shock relative to its absorption capacity is less than average. That means this group will have some excess capacity to absorb other guys' shock, right? Okay? And in the case that this group has no direct exposure to the shock, then this actually minus K1 becomes a measure of this group's absorption capacity. Okay? Of course, in the case that if there's only one transmitter in the market, we aggregate everybody else's absorption capacity. We can also use this as an indirect measure of the transmitter's market impact, right? So basically, we can sort of do this direct approach or indirect approach, okay? And actually, the indirect approach actually could be statistically more reliable because the first stage we're requesting a price on the shock rather than as the direct approach we're going to request position on the shock. We know position are usually more noisy in the measurement. Okay. Said this about sort of the framework. We think the framework has quite some advantage by taking into account of reaction of all groups. We are less likely to miss sort of effect of any particular group because of excessive focus on other groups, right? If we put a lot of emphasis on index traders, we might miss out the effect of hedge fund and vice versa, right? So now we have everything. And also we identify not just transmitter, but the absorber. Okay, so let me quickly report some results. We're going to use the CFTC large trader reporting system to count data there to implement this framework. So this data is discussed a lot in the conference. I won't say anything. The commodity, we're going to look at all the 19 commodities covered in the two popular commodity indices. We need to do some trader classification. Due to the time, I'm going to be very brief here. It's very important for us to have a measure of position of all these groups actually exclusively. So this sort of is a big challenge because actually the publicly released data actually quite often overlap with each other. Like the CFTC supplemental index trader report overlaps actually with other sort of groups we're talking about here. So it's important we actually cut this sort of separately. And informing these groups, we try to be conservative because we want to sort of the group we highlight out pure. So that's we might sort of miss out some potentially ambiguous traders in one group, say in index trade or in hedge fund. But we want to sort of the group we take out to be pure, so that the fluctuation in the group's position actually is reliable, which is important sort of for us in terms of its reaction to shock, right? Due to the time, I will skip sort of the movie I want to play with you for what involves in the market. Let me just give you some highlight about different groups here. Here is sort of the net position of the three groups we highlight. One is index traders, so the green line. So this is its net positions across our sample from 2000 to a couple of months ago. We can see sort of the big run up, of course. It came down during the crisis, then climbing back again. So the blue line here is actually hedge funds. So you can see sort of hedge funds actually had a very similar sort of trend in the position over time, except actually hedge funds trading position are more volatile, but the rough trend actually are quite similar. The black line here is the hedge commercials, okay? Commercials are largely on the short side, okay, which is not surprising. There's a gray line actually are others. Because of our conservative cut, actually, a lot of guys who are supposed to be labeled as commercials actually end up in the others, okay? Also, the figure I showed you, sort of this is marked by current price. So to figure out a price effect, we use, say, same-day price. December 15, 2006 price to mark all the positions. So then we get sort of a net position change. Very similar pattern. So rapid growth in index trader positions before 2008 came down, then coming back again. A hedge fund has similar positions, even though, during this period, actually, it went into short position, but in the trend, actually, quite, by a large part, very similar. Some basic summary of the, let me skip this. Overall, sort of index traders, each index trader position is large, but there are only not that many of them. There are many hedge funds there. Each, because of their sort of position, sometimes long, sometimes short, actually on average, actually not that big. Hedgers tend to take a negative position, okay? Let me really need to summarize the key result. One thing actually I think definitely worth mentioning is the traders' position change correlation with commodity return. Actually, interesting to see that by large parts, there's little correlation between index traders' position change and the price and the commodity return. Okay, across many commodities, very little evidence of that. But for hedge funds, there's overwhelmingly positive and significant correlation between their position and the price change. Hedgers tend to take the opposite side. That means their correlation is negative, others also negative. So it's interesting to see somehow, sort of over the weekly frequency we have been looking at, there's little correlation, slight positive, but largely little sort of correlation between for index trader. Now let me sort of quickly summarize what we see in this seismology kind of framework. The various table here, I probably don't have time to show you the detailed result. Rough pictures, let me go to the last slide, I'm out of time. Let me summarize this, okay? If we look at the different groups' reaction to, say, S&P 500 return, okay? Before 2006, we don't see anything, okay? Nobody react either way, negative or positive. There's very little, no reaction at all. In fact, we say 2006. In fact, sort of more analysis later also shows that even until 2008, there's really nothing, okay? And then after 2008, suddenly we see reaction. Okay, positive and significant reaction from index trader group to both current and the past week S&P return. Positive and significant response from hedge funds to current week S&P return, although not the lagged ones. Okay. On the other hand, commercials and others are on the other side. That means when index traders and hedge funds are buying in response to the S&P return, so hedgers are selling. Okay. And if we look at sort of how linked the position change with the price. So there's also a significant link between index traders and hedge funds traders buying with increase in price. So that means we done sort of the test I mentioned earlier. Index traders and hedge funds tend to be the transmitter of the shock, okay, with commercials and others as the observer. So this is also basic pictures. And also we use this. We can estimate the sort of exactly sort of the magnitude of the impact and so on. So roughly speaking, across ex ante before sort of doing this, I would expect the impact number to be all over the place across different commodities. But actually, they are not too far away from each other. Roughly speaking, it's like $1 million buying is associated with like a few basis point price change. Okay, we do this indirect approach versus direct and indirect approach. Actually, the numbers are fairly consistent with each other in terms of this impact. Okay. Just give me like half a minute to sum up. So based on this, the results are still very preliminary. We're still fine-tuning. So the exact timing is 2008. Actually, I think it's more really just like September 2008. So so far, what we see is sort of no noticeable transmission before 2008, but suddenly, sort of everything comes out immediately, sort of as a result of the financial crisis. We see sort of financial investors become a transmitter of equity market shocks. So this sort of is consistent with many had been argued. Sort of after crisis, the financial investors are worried about their own cost of funding, worried about their own risk exposure, so that they are vulnerable to other shocks. Okay. On the other hand, actually, this sort of drags sort of commercial to be on the other side, basically. So this is the rough sort of takeaway here. So I think sort of this approach is potentially useful to sort out many issues sort of related to heterogeneity in financial markets. What's the different role played by different traders and so on. Let me conclude. Stop here.
Thank you to our 4 speakers. We have about a half hour now that we can use for some questions or discussion. If you have a question, please come to the microphone, identify yourself. I found the last paper interesting in part because I think of the hedgers coming to the market and speculators standing there, you know, ready to absorb or take on. And here we've got a result where it seems like the other group is coming to the market and the hedgers are standing there absorbing. So it's a different kind of change of turn. Please come to the microphone.
My name is Neil Gillen. I have some observations and, I guess, questions for Wei Zhang, not based on your presentation, but on the paper. When you talked about increased inter-commodity correlations, you made the point that inflation had been a prior driver. Did you consider unemployment as a factor, such as present-day circumstances? Another point was that in one of your charts you had used prices in China, and in those particular contracts, particularly the corn and the wheat contract, were highly illiquid. And you indicated that index trading didn't have an impact there. I was wondering if you considered using data from other countries where there were no index trades, such as England or Japan, if you would have reached a different conclusion, or such as that, you know, the China market was an anomaly for comparison purposes. The other point I wanted to make is that in your paper you indicated that commercials had a difficulty with liquidity, but I think the data belies that fact in that for every bushel of grains consumed by, purchased by an index trader, that there is a corresponding 1.5 to 2.5 increase in trades, increase in sales by the commercials. And finally, the other thing I wanted to point out, which is the point that Dr. Wright made very effectively, is that in one of your footnotes, you indicated that ethanol was really not a factor in 2008 in influence on prices. But at that time, you had ethanol consuming 4.6 billion bushels, while the index traders were purchasing only 647 million bushels. That's a, you know, that's a 7 times multiple, and so I just wanted to make that point. Thank you.
Okay. Thanks for the question. I think most of your question actually is about my earlier paper, actually not the paper I presented here. So let me be brief, not to sort of defect from the current panel. Sort of this question about inflation. Yes, in my earlier paper we did look at the sort of inflations. I think in the 70s and the early 80s, inflation were high. At that time, actually, correlation between different commodities were high as well. right? So I think this is to be expected because of the the common factor inflation, right? But in the later period, the inflation is low, and also there's a little inflation variability. So in that sense, sort of it's hard to attribute the increase in cross commodity correlation to inflation, right? So that's sort of the point there. So you raised this issue about China. There are sort of we just done a very simple contracts there because China sort of the index investment is not issue, right? So that's why sort of I think that's why we see also in China the cross commodity correlation is not that high, not as high as what we observe here in US. So that's I mean this is not to say that the futures price and in China and the US they're so different in many other aspects, right? In fact, I actually want to use this opportunity to say a little bit about the sort of the discussion we had from last panel about the sort of inventory sort of in other parts of the world. Actually, there's a very interesting episode. I think it's kind of interesting to bring up here about cotton in China. Actually, some friend in China actually gave me some data about cotton inventory in China, which is in a very preliminary form. I didn't compile this yet. So, but the interesting it's interesting actually to note that in the last 3 years, there had been sort of rise in cotton price. And actually, together with that trend, the rise in cotton price, actually, many farmers actually piled up on their cotton actually over the 3 years actually. And of course, the cotton price crashed earlier this year, right? Actually, many cotton farmers were caught with all the sort of cotton they piled up. So actually, it's hard to say, well, is this rational, irrational? But certainly, I think many in China argued that the cotton farmers sort of got a signal from the futures price that, a futures price for cotton like 2 years ago was very high. So they took that as signal actually to pile up instead of selling to the market. Now they're stuck with their cotton at low prices. I thought this is sort of another example. Sort of people may take the signal to different way, right?
Thank you.
David Lehman?
Yes, hi, I'm Dave Lehman with CME Group, and a couple of questions for Aaron and then also one for Wei. Aaron, in your analysis, you noted that capital costs are obviously part of the carrying charge calculation, and I just wondered if you consider the kind of the implicit guarantee or explicit guarantee that the clearinghouse performs or provides for these delivery instruments, if that would enter into your analysis and what impact it might have. And then the second question had to do with the smooth proxy chart that you showed when you were showing the regression results, I think, and you showed an alternative estimation method of what the expected present value of that basis was or carrying charge was. I wasn't quite sure what that smooth proxy calculation was.
So I'll answer the second one first. So we argue that the wedge in storage costs or storage prices is the driving factor in this phenomenon. And we don't observe that wedge, but we observe the wedge plus noise. So when we did this thing where we said, let's assume that everybody in the market observed and knew exactly what was going to happen to wedges over the infinite future, how close would the implied basis be to what we actually observed? So then we don't actually observe that wedge, so we need a way to approximate it. So the two things we did is we took our regression predictions, and then we just took a moving average of that approximation that we have. So that was what I meant by smoothed proxy that I didn't get time to explain. In terms of the guarantee from the clearinghouse, I think it's implicitly. I I think default probability, I guess, is 0 in this modeling and the way we're thinking about it. So it's in there. I think so. It would be an additional thing to incorporate the possibility of liquidity shocks from margin changes or failure of a possible failure of clearinghouse or something like that. So I think it's implicit in what we're doing that these derivatives will pay off as contracted.
And if I could real quickly, Sally, to Wei, it looked like you were presenting some tables with data for CITs or commodity index traders that went back to about 2000. And I just wondered how you calculated those positions prior to 2006. I believe that was the first actual data that CFTC released on index traders.
Right. So actually, we actually constructed the classification ourselves based on some common sense rule. Basically, we know index traders are supposed to take a long position, and they're supposed to follow index, which will have multiple commodities, right? So we have a rule that if on a given year, if the total the average number of commodity a trader holds is about 8, and the average percentage of position long is above 70%. We classify that as index trader. Okay. Of course, we have to sort of verify this. In fact, sort of based on our classification, we verify that with CFTC's classification, say for the period after 2006. I think they match reasonably well, although there's some variations. But actually, the variations actually to our main result actually is inconsequential. Okay, so we basically extract our classification back sort of before 2006. Yeah.
Bob Ryan again from Limehouse Research. Question for Wei. Is your contention that the presence of index traders and hedge funds accounts for the increased correlation between these various commodities and now the S&P?
Yeah, so let's just focus on what's presented here. I think yes. I think clearly sort of their trading helps us understanding the rapid increase correlation between stocks and commodities after 2008.
You had an earlier paper where you said that there was an increase in correlation among commodity contracts,
right,
as a result of the presence of hedge funds and index traders. Right?
Index traders, yeah.
It's a similar theme.
Yeah.
Right. Okay. Bear with me a moment. Did you use an article done by Robert Pindyck and Julio Rottenberg? Are you familiar with that? 1990.
Yes.
They did a series that went from April 1960 through November 1985. And they used ag, softs, base metals, precious metals, and crude oil. And the name of the paper was The Excess Co-Movement of Commodity Prices.
Mm-hmm. Mm-hmm.
That was recently updated by a World Bank paper by Bappas and Haniotis. What Pindyck and Rottenberg found was that there was a very high co-movement or a very high correlation in the 1960 to 1985 period that they couldn't explain vis-a-vis macroeconomic shocks. What's very interesting here is there were no futures markets for crude oil until 1983. So the vast majority of that period that they covered had no widely accessible trading market for crude oil, nor in some of these other markets that they looked at among the ags and the softs was there large participation or trading. They were using Journal of Commerce price indices. And they still found these very, very high co-movements and very high correlations that they could not explain. Now, and this also was updated in that World Bank working paper. And they just took it right where Pindyck left off. The interesting thing here is that if they are indeed not spurious correlations, then one would presume that they are co-integrated. And if they are co-integrated, then everything that you're looking at is moving through time around some common factor, okay? And that is how they get their correlation vis-a-vis that co-integration. And it's not clear that the arrival of index traders or even hedge funds is the explanatory variable. The explanatory variable may very well be the business cycle over long periods of time where they are all in the similar funding cycle and a similar supply-demand cycle for basic raw materials. That would be one observation.
Okay, thanks for the question. I'm not aware of this new World Bank paper, but I do know Pindag-Rodenbeck paper. So if I remember correctly, actually they attribute to the correlation they observe to market sentiment, right? And in fact, sort of compared sort of correlation at that time actually is, despite they already claim that correlation is excessive, but that correlation is nowhere near what we observed lately, right? So we actually talked about another magnitude higher correlation here. So again, I think we are talking about quantitative question here, right? So how much is attributed to what? I think we can debate, but.
You had a systemic shock in the second half of 2008, first quarter
Mm-hmm.
of 2009.
Mm-hmm.
It was purely systematic. All correlations went to 1. I looked at it a little bit in some of my own stuff, and I did a screen that just exercised the most. It would deny all correlations unless it were something approaching 1, right? Fisher's Z transformation, and that's the only time that shows up, right? Where you get all these markets moving, in the same direction with a correlation. That is by definition a systemic shock. I think you got to go back to the 30s
Mm-hmm.
to find anything comparable in terms of commodity price returns. And again, in logs, not in price levels.
So that's why actually I thought sort of what I just presented is interesting in that way, right? So we see like actually who reacted to the shock in the market, right? It is clearly there's index traders and hedge funds, right? With hedges on the other side, right? So in that sense, sort of one would argue if this is a fundamental, actually we expect commercials to react first, right? Because they feel that the supply and demand actually immediate through their sort of primary businesses, right? But we see the opposite.
You had a 9% contraction in oil demand in that period. So what you saw was an immediate backing up of oil inventory and an explosion in the contango in the oil markets, reflecting that massive increase in oil inventory that was going unused. The other thing is that with that financial market meltdown, all trading markets came to an absolute shutdown. They stopped trading. And that is by far the dominant effect that you observed, even in your own graph where the correlations went off the charts. I mean, it oscillated around 0 and then it went to 1.
No, 1.7.
Whatever. It may as well be 1. But the point of it is that every trading market shut down. Commodity markets shut down, equity markets shut down, bond markets, the overnight markets, the funding markets completely shut down.
No, actually, I disagree with this. I thought that many studies actually showed that nothing really shut down, right? Even in the interbank funding market, the various recent research showing that actually was still funding. So it's just like it's not as sort of liquidity was reduced, but certainly didn't frozen, right? But anyway, so I think that's drifting away. I thought sort of what you mentioned something sort of interesting about sort of inventory was piling up, but that actually make the increased correlation more interesting in the sense that it's not like after September 2008 we are running on sort of really low inventory, right? We actually had a lot of inventory at that time, but now there's price actually moving with the financial market, right? So I thought this is actually, given what Brian talked about, sort of, I'm very sympathetic to what you said. But on the other hand, what happened actually after September 2008 is actually special in that regard, right? Because one would argue there's a lot of inventory, but now the price actually moved quite a bit with other things.
Well, let's give the rest of the panel a chance to respond to that.
I'm glad you raised that. This relates also to the previous session where there was an interpretation of financial inefficiency related to large contango. And the contango that happened, I think, in the second half of 2008 was, I think, pretty clearly associated not with the increase in inventory, but the inability to increase the oil inventory any further, because they just ran out of places to put the oil. All the tankers were full of oil. Iran had already filled a lot of them with sour crude. A lot of other things going on. In fact, it was a complete financial market failure, not an overactive financial market that happened then. You've got to think about the margin, not the average. And nobody could store oil. I know I couldn't, and I sure as hell would have it if I could have made that $30 or $40. Nobody could find a place to put it. So it actually backs up the theory. And the other part of that is that the futures market was actually an underestimator of the subsequent price increase. So the futures market was doing its best to actually reflect sentiment pretty well. It was the spot market that was screwed up.
Any other comments on the papers from other panel members or response to anything?
I just maybe one comment on the discussion we've just had here. It seems in Wei showed the graph that when we hit September 2008 in the financial crisis, that aggregate demand dropped through the floor, and that brought down stock prices, and that brought down commodity prices, and so we saw correlations being very, very high. I think one thing that's interesting about the work he's presenting is to try to understand just in price discovery in markets. We don't need to think that there's anything nefarious going on to ask the question who is trading and who is bringing the price discovery to markets. And so, you know, the result he showed, and that I found in some of my work too, that it tends to be hedge fund positions that move with prices, and it tends to be commercial positions that move in the opposite direction to prices. Tells us something about, suggests something at least about who's coming to the market with information.
Okay, one more question from David Lehman.
Sorry, thanks, Sally. Question for Randy. Your chart showing the, I think the support price for dairy. I'm not sure if that was a milk price or a cheese price or what it was, up until about the mid-90s, I think, being right on top of the, well, that being the price, the cash price being below that. And then later on in the time series, you showed the cash price moving above that support level, and then now we have risk and we actually have a market. This brings up, you know, that this market is very difficult from our perspective, from a futures exchange perspective, to keep a contract designed correctly to reflect the underlying market when the underlying market is impacted so much by policy. I noticed yesterday there was a row back here with signs on the seats for congressional staff, but I didn't see anybody in that row. And I don't think the signs are even there today, so this might be a more appropriate question for them as to what can we expect in the future in dairy policy. I assume you're kind of close to this as well.
I don't know what to assume, except it's a dynamic environment. There's talks about changing the milk classification pricing system, and if that happens, obviously the milk price contract has to be redesigned again. The Class 3 contract is which is why I focused on it. It's by far the largest volume, even though I still consider it a quite thin contract in the entire dairy sector on the derivative side. And so if we have to go back through a redesign of that, we have a whole new learning experience. In fact, one of the things I would argue is the reason we see such a small percentage of the open interest by the non-commercial sector in this particular market is they've had to relearn this over and over and over. What does this really mean as a price discovery vehicle? What am I really balancing myself against on the cash market side? And how do I anticipate that this contract is in fact something that if I invest time learning to trade will actually be around long enough to earn a return on that investment? So there's going to be a large dynamic component to continue as we go forward into the public arena sector, thinking about how the cash market is going to be managed. I don't have any insight for you on where we're going, except that there is pressures to reconsider the way we're pricing things now.
Well, I think given that we've all stayed through the noon hour and paid attention, that it's a good time to close this session. And I'd like to thank all the presenters very much for staying on time and leaving plenty of time for discussion. And I'd also like to thank Andre and the CFTC for a wonderful conference, and pleasure to be part of it.
Thank you very much indeed. Thank you, Sally, for chairing this panel, and the panelists for such an enlightening set of presentations, and audience members for a great set of questions. Thank you all of you for coming here. I especially like to thank the program committee, Ken Singleton, Wei Zhang, Scott Darwin, Michelle Robe, Garrett Roundhorst for making this conference happen, for really looking through the papers, for helping with identify the papers and the panelists and everybody. And again, the audience participation has been tremendous. Give yourselves a round of applause. Thanks a lot.